Goldman Sachs, the Wall Street investment bank, has a storied history. Founded by Marcus Goldman 150 years ago, his son Henry revolutionized the industry with company valuations and IPOs. It was the gold standard in investment banking for decades. Partners got rich when the company went public. But the firm's reputation took a beating during the financial crisis, eventually leading to one of the most interesting pivots in Wall Street history. Welcome to yet another thrilling and fun video. In this video, we will explain how Goldman Sachs got so big and its role in the biggest financial crisis ever. Make sure you're subscribed to our channel for a library of incredible videos. Also, hit the bell icon to get notified about our newest updates. Goldman Sachs has been a respected player in world finance for more than 100 years. The company operates as a leading global investment banking and securities firm. Goldman has served the most important people in the world, heads of state, heads of corporations, millionaires, billionaires, and the consumer before they were blamed for the worst financial crisis since the Great Depression. Considered one of the top investment banks in the world with a history of making more money for the wealthy, Goldman Sachs is the biggest of the old investment banks with almost $1 trillion in total assets. Currently facing ongoing cases, a lot of emphasis has been focused on the firm losing its way and tarnishing its traditional values. It's worth looking back at the good old days before their controversial role in the global financial meltdown. The company was founded by Marcus Goldman, a Bavarian school teacher who immigrated to the United States in 1848. After 21 years in the retail clothing business, Goldman knew well that merchants like him needed most of all cash. He used the family's move north to start something new, buying small business IOUs at a discount. Then, once he had accumulated enough IOUs, Goldman would make his way uptown to the banks where he would negotiate to sell the papers he was accumulating for more than he had paid for them. The difference between the buying and the selling was his profit. In his first year, Goldman bought and sold some $5 million worth of IOUs and pocketed a profit of around $250,000 on the notes he had bought and sold. He quickly became a very rich man, and the Goldmans bought a 90-foot tall, 25-foot wide brownstone mansion at 649 Madison Avenue at what is now the corner of 60th Street. In 1882, Goldman's son-in-law Samuel Sachs joined the business, and eventually the firm expanded into a general partnership in 1885 as Goldman Sachs & Company, when Goldman's son Henry and son-in-law Ludwig Dreyfus joined the group. Henry Goldman led the firm in new directions by soliciting business from a broader range of interests located in Providence, Hartford, Boston, and Philadelphia. In 1887, Goldman Sachs began a relationship with the British merchant bank Kleinwort Sons, which provided entry into international commercial finance, foreign exchange services, and currency arbitrage. On the strength of this growing exposure, Goldman Sachs won business from several Midwestern companies and handled the accounts for Sears Roebuck and other non-railroad companies. At the time, railroads were the preferred investment of financiers in the eastern United States, but Goldman Sachs committed to a diversified portfolio and saw great potential in a number of other developing industries. Eventually, the company co-managed its first IPO. In 1906, one of the firm's clients, United Cigar Manufacturers, announced its intention to expand. Goldman Sachs, which had previously provided the company with short-term financing to maintain inventories, advised United Cigar that its capital requirements could best be met by selling shares to the public. Although Goldman Sachs had never before managed a share offering, it succeeded in marketing $4.5 million worth of United Cigar stock. Within 1 year, United Cigar qualified for trading on the New York Stock Exchange. On the strength of this success, Goldman Sachs next co-managed Sears Roebuck's initial public offering IPO that same year. Henry Goldman was subsequently invited to join the boards of directors of both United Cigar and Sears, and ever since the practice of maintaining a Goldman partner on the boards of major clients became a tradition that continues today. The company's expansion continued well into the 1920s. Goldman Sachs, eager to take advantage of the promising economic climate at the time, formed an investment subsidiary called the Goldman Sachs Trading Corporation. The new company expanded rapidly, but in the fall of 1929, Goldman Sachs Trading, like many other companies, fell victim to a crisis of confidence that forced the stock market into a devastating crash. By 1933, the investment subsidiary was worth only a fraction of its initial $10 million capitalization. The company's recovery from the Depression was slow, but by the mid-1930s, the commercial paper and securities businesses again were highly profitable. During this period, Sidney J. Weinberg, an outsider in the family business, assumed a leading position within the firm. Weinberg and other outsiders drove Goldman's expansion after the crash. Under Weinberg, Goldman expanded into arbitrage for securities and currencies. Goldman also began its close relationship with the government, helping to secure financing for World War II and the Korean War. Goldman Sachs was no longer a small bank. By the 1950s, Goldman enjoyed close relations with the government and had choice IPO clients like Ford. Goldman Sachs' most important management of a new share issue occurred in November 1956, when shares of the Ford Motor Company were sold to the public for the first time. As co-manager, Goldman Sachs helped market 10.2 million shares worth $700 million. Already hugely profitable and well-diversified, Goldman added commodities trading to its portfolio by buying out J. Aron & Company. The company also bought up overseas banks and created new partnerships to expand its international operations. Goldman began spinning off certain operations to minimize some of the risks of its speculation while still garnering profits. At the beginning of the 90s, Goldman recorded record-breaking profits year after year thanks to operations that covered everything from offering Japanese equities to the U.S. to bankruptcy turnarounds. If there was profit to match the risk, Goldman was there. Goldman Sachs, now a publicly traded firm with over 43,000 employees and a market capitalization of around $129.94 billion, has considerably changed the products and services that it provides its clients over the years and has become more sophisticated. Following Goldman's IPO, the firm enjoyed a boom. It made money hand over fist. It hired top bankers away from other firms. It built up its private equity business. It perfected its position as the world's top M&A advisor. Its trading desk exploded with gunslingers and rocket scientists. Just kidding, but you get the point. Going into the 2008 financial crisis, Goldman's proprietary trading desk, where the firm bet its own money, proved to be a godsend, while some of Goldman's competitors, Bear Stearns and Lehman Brothers, shut down. Goldman's proprietary trading desk, with support from the top executives at the firm, had anticipated trouble in the mortgage market and made a huge proprietary bet that it would collapse. Goldman bet right and made a $4 billion trading profit on that desk alone in 2007, when the rest of Wall Street was suffering mightily. In August 2007, the gathering storm clouds of what would become the worst financial crisis since the Depression darkened in an ominous fashion. Very few people recognized that there was a financial and economic disaster on the horizon. Even in the face of obvious red flags like the housing bubble being unsustainable, the massive global imbalances in trade and capital flows, and as a consequence of financial leverage in many forms, the financial system was bloating in relation to the economy in an unsustainable way. No one could have anticipated the speed and devastating degree to which the crash happened, except Goldman Sachs. They anticipated the crash from miles away, didn't tell anyone, bet against the market, and made billions in profit just from that trade. As the 2008 global financial crisis continued to challenge markets, leading Wall Street firms worked to ensure that they were adequately capitalized and had sufficient liquidity. While many U.S. firms looked overseas for capital infusions, Goldman Sachs found willing investors closer to home. At the height of the global financial crisis, Warren Buffett's Berkshire Hathaway invested $5 billion in Goldman Sachs, further strengthening the firm's capitalization and liquidity in turbulent times. But while Goldman weathered the financial crisis far better than any of its competitors, it lost the ensuing public relations battles on both Main Street and Washington. This was yet another crisis for the firm, and one that it eventually overcame through the passage of time and by deciding to be somewhat more transparent about its businesses with the public and the press. In 2018, Goldman had to deal with another scandal involving its bankers in Asia and a corrupt Malaysian sovereign wealth fund. The scandal, while not as existential as Goldman's other scandals, has once again damaged the company's reputation. Goldman Sachs was investigated for its role in raising $6.5 billion in 3 bond sales for the One Malaysian Development Berhad, OneMDB State Fund. Between 2009 and 2013, OneMDB raised billions of dollars in bonds for investment projects and joint ventures. The Malaysian and U.S. authorities discovered that $4.5 billion, including some of the money Goldman helped raise, was stolen from OneMDB in an elaborate scheme that spanned the globe and implicated high-level officials. The siphoned funds were used to buy luxury assets and real estate, including hotels, a private jet, art by Picasso and Monet, and to finance Hollywood films. The Department of Justice has sought to recover about $2.1 billion in assets linked to diverted OneMDB funds, the largest ever asset recovery action brought by the agency. Goldman Sachs has been investigated by regulators in at least 14 countries for its role in underwriting the OneMDB bond issues, and they were found to have violated the U.S. Foreign Corrupt Practices Act, which bans U.S. companies from paying foreign government officials for help in getting or keeping business. Goldman Sachs pleaded guilty to violating U.S. foreign bribery rules and will pay a $2.9 billion fine to the Justice Department and other regulators, as well as $600 million in disgorgement of ill-gotten gains to settle the U.S. probe and avoid a criminal conviction at the group level. This is in addition to the $3.9 billion that Goldman has agreed to pay Malaysia in exchange for dropping all criminal charges against the bank. Of course, the company's done its best to rehabilitate its image. It invested $40 billion of its own and its clients' money in renewable energy products over the next decade. The investment bank described the renewable energy sector as one of the biggest profit opportunities, comparing it to technology investments in the 1990s or to investing 10 years ago in fast-growing countries like Brazil, Russia, India, and China. Goldman also helped finance $4.8 billion in clean technology companies globally and co-invested more than $500 million in that area. They've not slowed down at all and have been involved in a lot of clean energy products globally. If they're paying for their sins, then it's safe to say that they've paid enough. I hope you enjoyed watching this video. If yes, let us know by giving it a thumbs up. Also, subscribe to our channel to watch more interesting and entertaining videos like this one.